The South Korean stock market suffered the fastest and largest drop in its entire history, falling more than 20% in a matter of weeks. This circular chart shows their market structure before the crash. Just 2 tech stocks made up over 50% of Korea's entire index. Investors then poured trillions into newly approved double-leveraged multiplier ETFs, building a massive mountain of debt on those same 2 companies. When regulators panicked and publicly warned that the market was dangerously overheated, it triggered an avalanche of margin calls. Traders were forced into automatic, desperate sell-offs, pushing prices even lower and triggering even more margin calls. A minor dip in chip stocks collided with extreme concentration and highly leveraged debt, turning a regular market correction into a historic financial collapse. Right now, here in the United States, search volume for the exact term market bubble has spiked to its highest level since 2004. Investors are looking at the wreckage in Asia and asking if the American stock market is hiding the exact same structural flaws. To find out if we are heading for a similar collapse, we have to run a stress test on the domestic market using the specific metrics that broke Korea. This bar chart compares the top 10 largest companies in the S&P 500 against the rest of the market. Those 10 heavily weighted stocks now make up roughly 37% of the entire index. Valuations are also stretched to extreme limits. The Buffett indicator, which measures total stock market value against national GDP, is currently sitting more than 2 standard deviations above its long-term historical trend. Investors are borrowing at record rates to chase these high prices. Domestic margin debt recently hit a staggering $1.5 trillion. At the exact same time, corporate insiders are selling their own shares at the fastest pace on record, while professional money managers are holding essentially zero cash in reserve. By almost every long-term mathematical standard, the United States stock market is heavily consolidated, loaded with debt, and stretched to its absolute limit. Wall Street argues the market is surviving this stress test because companies building our artificial intelligence infrastructure are generating massive, tangible profits. Overall corporate earnings growth is running near 25%. Unlike the dot-com bubble, where companies had zero revenue and traded purely on hype, the current tech build-out is funded by real cash. Smaller companies are also starting to thrive. The equal weight index and small cap stocks are rising, indicating a broader and much healthier foundation for the current rally. If artificial intelligence delivers actual productivity gains across the economy, the market has a genuine mathematical path to grow into these extreme valuations without collapsing. The fatal flaw in this argument is that current stock prices leave absolutely zero room for error. The 5 biggest tech companies are expected to spend $534 billion on infrastructure by 2027, while only generating $340 billion in operating cash flow. They are spending $1.57 for every single dollar they get back. This line graph shows the mathematical reality if those investments underperform. If earnings disappoint by just 5% and the price-to-earnings ratio compresses down to a normal historical average, it instantly triggers a 25% drop in the S&P 500. A severe loss of that magnitude does not require a recession, a geopolitical catastrophe, or massive panic selling. It simply requires investor expectations returning to normal. Despite these extreme risks, the United States is highly unlikely to suffer the exact same rapid, uncontrolled collapse we saw in Korea. Our top 10 companies making up 37% of the index is historically dangerous, but it is vastly different than 2 companies making up over half the market. We also have deep global pools of institutional buyers and trillions in automatic retirement fund inflows that purchase shares every 2 weeks regardless of price. While leveraged retail ETFs exist here, they make up a tiny fraction of our overall volume. We rely on decades' worth of systemic circuit breakers designed specifically to halt trading and prevent a rapid algorithmic death spiral. A total systemic breakdown is highly improbable. However, the mathematical risk of a severe 20 to 40% correction remains incredibly high for the average investor. Surviving this high-risk environment requires holding a strict 3 to 6 month liquid cash emergency fund at all times. Investors must also diversify their portfolios far beyond American tech stocks, moving capital into international markets, real estate, and hard commodities. You must avoid using margin or leverage. If the market suddenly corrects, you never want to be forced to liquidate your assets to cover a loan. Historically, holding the broad United States market for a continuous 20-year period has literally never produced a negative return.